Bitcoin recently crashed into the $60,000 range, creating chaos across the entire market. Not only did this drop push BTC below key support levels established during the previous cycle, but it also placed Bitcoin's price squarely in the danger zone for miners. Many mining operations are now running at break-even or worse. Some have been forced to shut down entirely. The result is that Bitcoin's hash rate has dropped significantly, and investors everywhere are asking the same uncomfortable questions. Is this the beginning of a death spiral for the mining industry? Has Bitcoin already found its bottom? And could this massive shock to miners actually be the ultimate buy signal? Today on Web3verse, Alex is breaking down the full picture. What is happening, why it matters, and what it could mean for your portfolio. Let's get into it. Let's start with the break-even crisis, because the numbers paint a stark picture. Bitcoin has been trending downward for months and recently settled into the mid-$60,000 range. This matters enormously because historically Bitcoin's previous cycle peak has acted as a reliable floor of support during subsequent corrections. Breaking below that level removes a critical safety net and creates genuine uncertainty about how much further prices could fall. For Bitcoin miners, this price action is not just uncomfortable, it is existential. Data from one of the largest crypto mining platforms reveals just how serious the situation has become. The shutdown price for the most common mining machine models currently sits between $46,000 and $67,000. In simple terms, if Bitcoin's price falls within that range, mining becomes unprofitable for the majority of operators running standard equipment. More advanced mining machines have a lower shutdown price of around $36,000 to $38,000, offering slightly more cushion. But some analysts have warned that Bitcoin could fall as low as $30,000 in this bear market cycle, which would make even the most efficient rigs economically unviable. When miners cannot cover their costs, they face two choices: sell their accumulated Bitcoin reserves to stay afloat, or simply switch off their machines entirely. Many will do both. As more miners exit, fewer machines are processing transactions and securing the network. The blockchain becomes weaker. And a weaker network can drive prices down further, creating a negative feedback loop that affects not just miners but every Bitcoin user and holder. But falling BTC prices are not the only force pushing miners away from the network. A significant number of Bitcoin mining companies have been pivoting toward artificial intelligence and high-performance computing infrastructure. And the financial logic behind this shift is hard to argue with. AI workloads can reportedly generate up to 25 times more revenue per kilowatt hour than Bitcoin mining at current price levels. That is not a marginal improvement. That is a completely different business proposition. The second factor driving this migration is infrastructure flexibility. Bitcoin mining machines are designed to do exactly one thing: perform the specific hashing calculations required to mine Bitcoin. The hardware itself cannot be repurposed, but the physical infrastructure surrounding those machines absolutely can be. The power systems, cooling technology, weather protection, and geographic positioning that Bitcoin mining operations have refined over years are almost perfectly suited to the energy-intensive demands of AI data centers. Major technology companies have recognized this. Firms like Amazon, Microsoft, and Google have been actively striking deals with Bitcoin mining companies to leverage their existing infrastructure for AI expansion. Most major miners are adding AI and high-performance computing as additional revenue streams rather than abandoning Bitcoin mining altogether. However, some have made complete pivots, selling off their entire Bitcoin holdings to fund the transition and rebranding away from mining entirely. This wave of selling from miners transitioning to AI has added meaningful downward pressure on Bitcoin's price at an already difficult time. All of this activity has had a direct and measurable impact on Bitcoin's hash rate, the total computational power securing the network. The hash rate recently fell below 1 zettahash per second for the first time in months. To put that number in context, 1 zettahash means Bitcoin miners are collectively making around 1 sextillion computational guesses every single second. Even at that level, the processing power involved is almost incomprehensible. But a declining hash rate still signals that fewer miners are actively participating in securing the network. The causes behind this decline are layered. Falling Bitcoin prices have squeezed profitability. Rising energy costs have simultaneously increased operating expenses, pushing more marginal miners offline. A severe winter storm across parts of the United States also forced multiple mining operations to shut down temporarily due to power outages caused by extreme cold. The combination of all three pressures hitting simultaneously explains why the hash rate drop was so significant. As fewer miners participate, Bitcoin's protocol automatically adjusts the mining difficulty downward. This is not a bug. it is a deliberately designed feature. The network recalibrates roughly every 2 weeks to maintain a consistent block time of approximately 10 minutes. A recent difficulty adjustment dropped by over 11% in a single day, representing one of the largest single-day difficulty reductions since China banned Bitcoin mining and triggered a massive forced exodus of miners from the network. So should investors be genuinely concerned about Bitcoin's security? The honest answer is not particularly. Even after dipping below 1 zettahash, the computational power securing Bitcoin remains enormous by any objective measure. Any actor attempting a 51% attack would need to deploy more specialized hardware and energy than the rest of the entire network combined, a cost running into the billions or potentially trillions of dollars. The practical possibility remains extremely remote, and the hash rate has already begun recovering, closing any brief theoretical window of vulnerability. There is actually a constructive side to miner capitulation that often gets overlooked. The miners who exit first during difficult periods tend to be the weakest and most financially overextended operators. Their departure reduces competition for remaining miners, meaning those who stay online earn higher rewards in the short term. This improved profitability then attracts new miners back into the network and incentivizes existing ones to reconnect their machines, causing the hash rate to naturally recover and stabilize. One encouraging longer-term development is the rapid growth of renewable energy adoption in Bitcoin mining. Recent data shows that over 57% of Bitcoin mining now runs on renewable energy sources, up from just 34% in 2021. Building independent green energy infrastructure helps miners sidestep the rising electricity costs that have forced so many operations offline. More financially resilient miners means more consistent network security and less forced selling pressure hitting the market during price downturns. Historically, miner capitulation events have frequently coincided with cycle bottoms. The fact that current mining stress is emerging roughly around the same price level as Bitcoin's previous cycle peak suggests the market may be finding meaningful support. However, even if a true bottom has been established, an immediate recovery rally is far from guaranteed. More likely is a period of sideways price action lasting weeks or potentially months while the mining sector stabilizes and market confidence gradually rebuilds. What is clear is that Bitcoin itself has not fundamentally changed. The protocol remains as robust as ever. The mining difficulty adjustment is working exactly as designed, and the long-term case for Bitcoin as a decentralized store of value remains entirely intact. That is everything for today on Web3 Verse. Drop your thoughts in the comments. We want to know where you think Bitcoin heads from here. And we will see you in the next one.